Hi, Mark Lund here, author of The Effective Investor. Today we're going to talk about market timing. The definition of market timing is any attempt to alter or change the mix of assets based on a prediction or forecast about the future. The myth is that active money managers are able to utilize market timing to effectively predict up and down markets. The problem with this may result in missing not just down days, but some of the best, most bullish days in the market as well. This mistake can be very hazardous to your wealth. Missing even just 5 of the best days of the market can have a substantial impact on your portfolio, as you can see in this chart. Now, this chart is covering data over a 20-year period. During this 20-year period, you could have been invested in the market a total of 5,040 days. Missing just 5 of the best days would have cut your returns almost in half. No one knows when those best days will happen. Dalbar conducted a study of individual investors over a period of 20 years. From the 20-year study, we learned the following. Now, this chart clearly indicates the average active investor only earned an average of 3.9%, while the S&P averaged a significantly higher return. Now, according to Dalbar, the average investor's holding period was only slightly more than 3 years for the 20-year period covered by the study. That means they were jumping in and out of the market at the wrong time. They were trying to attempt to time the market. Investors that time the market actually lose money over the period measured. It isn't difficult to see that market timing is a very risky proposition when it comes to building wealth. Being out of the market is simply too big of an opportunity cost. Now, Charles D. Ellis, a managing partner of Greenwich Associates, the leading consulting firm specializing in financial services worldwide, he wrote a book which was required study material for investment advisors. Now, he said, the evidence on investment managers' success with market timing is impressive and overwhelmingly negative. Now, a final point about market timing. The main reason people want to get out of the market when it is going down is that they feel like they're going to lose money. The key point to understand here is that when the market goes down, you only lose money if you sell your stock while it is down. If you don't sell your stock when the market is down, you technically have not lost money. It is the value of the stock that has declined. You still own the same number of stocks. When the market goes back up, your stocks go back up in value as well. Now, here's a very critical point to understand about actively managed mutual funds. The fund manager is selling stocks in your mutual fund when the market is down. That means you really may be losing money in a down market if you own actively managed mutual funds. This is also why people will feel like their portfolios don't recover the way they should after a crash. Their funds were owning different stocks than when it went down. This is one of the reasons why we don't use actively managed mutual funds in our portfolios. Well, if you have any questions, please feel free to contact me anytime, and have a great day.